The upside gap 3 methods is a pattern in the field of technical analysis, specifically identified within bullish markets, signaling the continuation of an upward trend. This pattern emerges on candlestick charts, which are a tool for investors to visualize the price movements of securities over a defined period. It begins with a long bullish candle, followed by a gap upwards, and then it presents a small body or two that do not close the gap. Finally, another long bullish candle appears, which closes above the first long bullish candle, confirming the continuation of the upward trend. In the journey of understanding the upside gap 3 methods, it is seen as a beacon for traders, indicating that the market's bullish sentiment is strong and likely to persist. This pattern underscores the market dynamics where, despite short-term fluctuations or consolidation within the uptrend, the underlying bullishness remains intact, pushing prices higher. For investors and traders, recognizing this pattern is crucial as it helps in making informed decisions about holding or entering a position with the expectation of the trend continuing upwards. When concluding on the impact of the upside gap 3 methods, it symbolizes a robust bullish momentum and provides a tactical advantage to those who can identify it. It serves as a valuable tool in the arsenal of technical analysts, enabling them to forecast with greater confidence the likely continuation of an upward trend. Thus, understanding this pattern can significantly aid in strategic planning and execution of trades in favorably trending markets. The downside gap 3 methods is recognized as a bearish continuation pattern that occurs within the context of a downward trend in the market. This pattern comprises a sequence of candlesticks that convey a pause or consolidation in the price movement before resuming the original downward trend. To understand this pattern, it is essential to visualize its formation. Initially, there is a long black candlestick representing a day when the market has moved significantly lower. Following this, the market consolidates, which may manifest through one or more small-bodied candlesticks. These small candlesticks are contained within the range of the initial large black candlestick, indicating a momentary equilibrium between buyers and sellers. Notably, there is a gap between the first candlestick and the subsequent consolidating ones, which is crucial to the pattern's identification. This gap is the market's way of taking a breath before continuing its descent. Finally, another black candlestick appears, closing below the initial long black candlestick's low, confirming the continuation of the downtrend. It is this closing action that signals to traders that the downtrend is likely to continue. The significance of the downside gap 3 methods lies in its ability to signal the continuation of existing trends, offering traders insight into market sentiment and potential future movements. To identify and interpret this pattern, traders rely on a keen observation of candlestick formations and an understanding of market trends. By recognizing such patterns, traders can make informed decisions in alignment with the prevailing market dynamics. Identifying the downside gap 3 methods pattern involves recognizing a sequence of candlesticks on a trading chart that suggests a continuation of a bearish trend. This pattern is comprised of 5 candlesticks. It starts with a long bearish candlestick, which is followed by a small body candlestick that gaps down from the first. This gap indicates a strong bear market presence. The third and fourth candlesticks are small-bodied as well and can either rise or fall, but must stay within the range of the first candlestick's body. Finally, The pattern completes with a fifth bearish candlestick that closes below the first candlestick's low, confirming the continuation of the downtrend. This pattern is essential for traders because it signals that after a brief pause, the price is likely to continue moving downwards. It offers an opportunity for traders to either enter the market with a short position or adjust their existing positions to manage risk. Understanding and identifying this pattern involves paying close attention to the candlestick shapes and their arrangement in relation to one another, as well as the trading volumes associated with each candlestick. The gap between the first and second candlesticks serves as a critical indicator of downward momentum, which is further confirmed by the closing of the last candlestick. The downside gap 3 methods is a bearish continuation pattern that plays a crucial role in deciphering market sentiment. This pattern is typically observed on candlestick charts and contains specific characteristics that signal the continuation of a downward trend in the market. The pattern consists of a large black candle followed by a small-bodied candle that gaps down from the previous one, and then a third black candle that closes within the body of the first candle but after the gap, confirming the continuation of the bearish trend. Understanding market sentiment is key to interpreting signals from patterns like the downside gap 3 methods. Market sentiment refers to the overall attitude of investors towards a particular security or the market as a whole. It is an intangible, psychological aspect that influences trading decisions and market movements. When market participants are predominantly bearish, it means there is a general expectation that prices will fall, leading to selling pressure that can drive prices down further. The downside gap 3 methods pattern is especially helpful in confirming that the bearish sentiment has not changed and the selling pressure remains strong. By analyzing this pattern, traders and investors can make more informed decisions about their positions, considering the likely continuation of the downward trend. It acts as a signal to maintain or initiate short positions rather than looking for entries to go long, in alignment with the prevailing bearish sentiment. The downside gap 3 methods is a bearish continuation pattern that appears on candlestick charts, indicating a continuation in the downward trend of a market. This pattern is formed during a downtrend when a long bearish candle is followed by a gap down in the market. This gap is then partially filled by a small bullish or upward candle. However, the key component is the third candle, which is another long bearish candle that closes below the previous gap, confirming the continuation of the downward trend. The nature of this pattern emphasizes the strong bearish sentiment in the market. It signifies that sellers are in control, pushing the prices lower even after a brief interruption by buyers. The formation of the pattern over these 3 candles suggests that any upward movement in price is temporary and that the downward pressure remains strong. For traders and analysts, recognizing this pattern provides valuable insight into potential future market movements, allowing for strategic planning around the expectation of continued bearish trends. In simpler terms, imagine watching a series of waves crashing onto the shore. The downside gap 3 methods pattern is akin to a particularly strong wave followed by a smaller one that does not reach as far. However, it is immediately followed by another strong wave, even more forceful than the first, signifying that the sea's power has not diminished. In market terms, this pattern warns that the downtrend is likely to continue, prompting traders to prepare for further declines. To confirm the signal of the downside gap 3 methods, a bearish continuation pattern, there are several key steps to follow. This pattern usually appears in a downward trending market and suggests the continuation of the existing trend. First, identify a large black candlestick which indicates a strong selling day. Following this, the market should gap lower, and one or several small-bodied candlesticks, white or black, appear. These smaller candlesticks should not climb above the low of the initial large black candlestick. Finally, another large black candlestick appears, which closes at a new low and thus confirms the bearish continuation pattern. This process is akin to watching waves recede farther out to sea, signaling an even stronger wave is coming. The initial strong selling day is like a wave pulling back. The small candlesticks represent the sea's temporary calm, and the final large black candlestick signals the arrival of a more powerful wave, pushing the trend further down. Understanding this pattern helps traders and investors prepare for the continuation of a downward trend and make more informed decisions regarding their positions in the market. The downside gap 3 methods is a chart pattern used in technical analysis to signal the continuation of a current downtrend. This pattern appears in a downtrend and is characterized by a large candlestick followed by a gap, and then a group of smaller candlesticks that do not fill the gap. The completion of the pattern with another large candlestick moving downward confirms the continuation of the bearish trend. Discussing the reliability of this pattern, known as the beacon of its strength in forecasting future market movements, it is important to understand that no pattern can guarantee market movements with absolute certainty. The effectiveness of the downside gap 3 methods pattern, like all technical analysis tools, depends on various factors, including market conditions, volume, and the presence of other confirming signals. However, when this pattern is observed with high volume and in conjunction with other bearish indicators, it tends to be a reliable signal that the downtrend will continue. Traders often use this pattern in their strategy, combining it with other analysis tools to make more informed decisions. It is crucial for investors to consider the broader market context and not rely solely on any single pattern or indicator to guide their trading decisions. The downside gap 3 methods is recognized as a bearish continuation pattern observed in the realm of technical analysis. It operates within the scope of predicting the continued decline of financial market prices following its identification. This pattern emerges in the midst of a downtrend, serving as an indicator that sellers are holding a strong position and the prevailing downtrend is likely to persist. Understanding this pattern requires identifying a specific configuration in price movements. It starts with a long black candlestick on the first day, signaling strong selling pressure. Following this, there is a downside gap leading to a small body candlestick on the second day. This gap is not filled, and the price does not move much from its opening spot, indicating a pause in the downward momentum. On the third day, another long black candlestick appears, closing within the body of the first day's candlestick but not filling the gap. This sequence reinforces the bearish sentiment in the market. Synergy with other technical analysis tools enhances the predictive power of the downside gap 3 methods pattern. Combining it with volume indicators, for example, can provide insights into the strength of the selling pressure. A high volume during the pattern's formation suggests a strong commitment from sellers. Meanwhile, oscillators and moving averages can offer additional confirmations. A moving average acting as a resistance level above the pattern may indicate that the downtrend is well established, whereas oscillators can signal oversold conditions, potentially leading to short-lived pullbacks within a broader downward trend. In summary, the downside gap 3 methods pattern serves as a valuable tool for investors and analysts aiming to interpret market trends and make informed decisions. When used in conjunction with other technical analysis tools, it offers a more comprehensive view of market dynamics, allowing for the development of strategies that capitalize on the continuation of bearish market movements. When discussing the downside gap 3 methods, a bearish continuation pattern, it is crucial to understand how to navigate potential pitfalls. This pattern, indicative of a continuing downward trend after a brief pause, requires careful analysis to avoid misinterpretation. One common pitfall is mistaking a single gap down for a confirmation of the bearish trend. It is important to look for a series of specific criteria, including the initial long black day followed by a gap down, and then another black day that closes within the body of the first day's candle. Recognizing these specific elements helps avoid premature or incorrect conclusions about the market's direction. Another challenge arises from overlooking volume. Volume plays a critical role in confirming the pattern. Ideally, the volume should increase on days with significant price movement down. If the volume does not support the price action, it may indicate weakness in the bearish trend, suggesting caution. It is also essential to consider the broader market context. The downside gap 3 methods pattern does not occur in isolation. Market trends, economic indicators, and other technical patterns should be analyzed to provide a comprehensive view of the market's potential direction. Lastly, emotional bias can lead to pitfalls. Investors might cling to preconceived notions about market direction, ignoring signals that contradict their beliefs. It is crucial to remain objective, focusing on what the data reveals rather than personal expectations. In summary, navigating the pitfalls associated with the downside gap 3 methods pattern requires a mix of technical analysis, attention to detail, and objectivity. By being vigilant about these common challenges, investors can more accurately interpret this bearish continuation pattern and make informed decisions. The downside gap 3 methods pattern is a configuration indicating that a current downward trend in the market is likely to continue. This pattern manifests when, after a long bearish candlestick, there is a gap down in the market that leads to the appearance of a smaller bullish or bearish candlestick within the range of the body of the previous candlestick. It is then followed by another bearish candlestick that closes below the gap, thus reinforcing the continuation of the downward trend. For strategic applications, understanding this pattern can be crucial for traders and investors who are looking to capitalize on or hedge against continued bearish movements. When identified, it suggests that it might not be an ideal time to enter into a long position for those looking to invest with the expectation of the market moving upward. Conversely, it can serve as a signal for those looking to enter a short position or sell off their holdings to mitigate potential losses. Moreover, recognizing the downside gap 3 methods pattern allows traders to set more informed stop-loss levels. By understanding that the market trend is likely to continue downward, traders can position their stop losses just above the gap or the high of the bearish candlesticks forming the pattern. This strategic placement helps to further protect against unwanted losses should the market unexpectedly reverse course. In essence, The value of identifying the downside gap 3 methods pattern lies in its ability to signal not just the continuation of a current trend, but also to inform strategic decisions regarding entry and exit positions, risk management, and overall investment planning in a bearish market scenario. The downside gap 3 methods is a bearish continuation pattern that signals the potential for a continuing downtrend in the market. This pattern is characterized by a specific formation that includes a long down candle, followed by a gap down in price leading to a smaller body candle, and then another long down candle. The middle candle is contained within the range of the first candle, creating a visual gap in the price chart. Exploring variations of this pattern, one might find that certain formations do not strictly adhere to the textbook definition, but still convey the underlying bearish sentiment. For example, the gap may be smaller than expected, or the second candle might show a slight upward movement within the downturn, indicating a brief pause in the bearish momentum rather than a complete reversal. These variations do not necessarily dilute the potency of the original pattern, but do require a closer analysis to understand the market context in which they occur. Recognizing these variations can provide a broader spectrum of analytical insights, enabling traders and investors to make more informed decisions based on subtle shifts in market dynamics.